All right, so let's dive right into the world of real estate. Think of this as your crash course on what makes this market tick. We've dug deep into reports from the heavy hitters like S&P and Crystal, and even unearthed some interesting court cases, some pretty surprising stuff. Like, did you know that some mall tenants pay next to nothing in rent? Or that developers sometimes end up, get this, in jail? We'll unpack all that and more in this deep dive.
It's a wild world, that's for sure. Full of twists and turns, kind of like a roller coaster.
That's a great analogy, and I think the first thing we need to wrap our heads around is just how crowded this market really is. It's not just a few big players calling the shots, right?
Not at all. Both in India and globally, the real estate scene is super fragmented. We're talking tons of smaller players, all scrambling for a piece of the action, and that has a huge impact on pricing power.
So if everyone's trying to grab a slice, no one really has the leverage to set the prices.
Exactly. Reports from CRISIL, Scope Ratings, S&P, they all point to this fragmentation as a defining feature of the market. And it's not just in developing countries either. Even in places like Europe, North America, Japan, smaller players often rule the roost.
Why is it so easy for new players to jump into real estate? You'd think there'd be more barriers.
Well, think about it. Setting up shop isn't that complicated, especially if you have some capital to play with. You can basically outsource a lot of the key functions like construction, marketing, even the design work. No need to build a massive team in-house.
Makes sense. And I bet financing isn't too hard to get either. Land and buildings, those are pretty solid collateral, right?
You got it. Lenders tend to see those as pretty safe bets, so it makes it easier for developers, even smaller ones, to get loans.
But wouldn't all these new players lead to some serious competition?
Oh yeah, definitely. The competition is fierce, and that's a big reason why many real estate companies, aside from a few big names, have very little control over pricing. They're constantly under pressure to stay competitive.
And then we got to throw in the wild card of the overall economy.
Right, real estate's totally tied to how the economy is doing. Interest rates, GDP growth, even employment numbers, they all play a big role in how much demand there is for property.
And here's where it gets really interesting for me. Real estate projects often have these crazy long development timelines. We're talking 3-4 years on average. So what happens if during that time the economy tanks?
That's a recipe for disaster for developers. They're basically shooting at a moving target, and missing the mark can have some serious consequences. Take Hong Kong's real estate market, for instance. Between 1997 and 2003, prices crashed by a whopping 50%. A combo of economic downturn and that cutthroat competition we talked about.
Wow, that's a pretty dramatic example of just how unpredictable this market can be. Really makes you think about how important it is to have a solid financial base. Speaking of which, let's shift gears and talk about cash flow. What's unique about real estate in this regard?
Well, one key factor is the heavy reliance on what we call customer advances.
Customer advances. Can you break that down for those of us who aren't real estate gurus?
Think of it as a hefty down payment. Buyers cough up a chunk of the property's value up front. And sometimes these advances can make up as much as 70% of the project's funding.
Wow, 70%. That's a huge chunk of the money coming from buyers before the project is even finished. What if those sales start to dry up?
That's when you run into a funding crunch. Construction might get delayed, could even grind to a halt, which then makes potential buyers even more wary of investing. It's a real tough spot for developers.
Like a domino effect. One problem leads to another, and suddenly you're in a real mess.
Exactly. A vicious cycle that's hard to break free from.
So we've got this crowded market, super sensitive to the economy, and heavily reliant on upfront cash from buyers. It paints a pretty intense picture. But let's talk about the players in this game. Does size always matter? Or can smaller companies hold their own against the giants?
It's not always a David and Goliath story, you know? Larger companies definitely have some perks, like economies of scale, being able to spread costs across more projects. They usually have an easier time getting funding, too.
And they have the resources to build those big, powerful brands and attract the top talent. Think of a company like DLF Ltd. In India. They're one of the leading developers, and their scale is pretty mind-blowing.
DLF is a perfect example of how size can translate into real market power. But even for a behemoth like DLF, location is still king.
Right. Even the biggest, most well-known developer can't overcome a bad location.
Absolutely. A smaller, less-known developer with a prime piece of real estate might actually have the upper hand, compared to a big name stuck in a less desirable spot.
So it's all about being in the right place at the right time, no matter your size. But I want to circle back to that idea of brand strength. How much of an impact does a good reputation actually have in this market?
A strong brand can be a total game changer. Studies show that developers with well-established brands can see sales happen up to 20% faster compared to their less-known competitors.
20%, that's
It
huge.
is. And that faster sales cycle means they're not relying as much on future funding, which can save them a ton on interest costs. We're talking millions of dollars potentially.
So a strong brand doesn't just boost sales, it also helps create a more stable financial situation. And we've already seen how crucial that is in this unpredictable market. But even with a strong brand, savvy developers know not to put all their eggs in one basket.
Right, you got it. Diversification is key to managing risk. And there are several ways developers go about doing this.
I'm really curious about these strategies. How do developers diversify their portfolios?
Well, one common approach is geographical diversification. By spreading out into multiple markets, developers can cushion themselves against regional economic downturns. If one area is slowing down, projects in other stronger locations can help balance things out.
So spread the risk geographically. Don't bet it all on one city or state. What other approaches are there?
Another strategy is segment diversification. Instead of focusing solely on residential properties, developers can mix things up, include commercial, industrial, even mixed-use projects in their portfolio. That way, they're not completely dependent on the performance of any one sector.
Like building a diversified investment portfolio.
Yeah.
Don't put all your money in one type of asset.
Exactly. And then there's client diversification. This is especially important for developers of office and retail spaces. Having a variety of tenants means they're less vulnerable if one tenant decides to leave. Or, worst case scenario, goes belly up.
Oh yeah, I've seen those ghost malls. They put all their faith in one big anchor tenant, and when that tenant bails, the whole place just goes downhill. Kind of depressing, actually.
That's exactly what developers are trying to avoid with client diversification. Another element of diversification is staggering project completion dates. Instead of having all projects finishing around the same time, they space them out. Ensures a more steady flow of revenue.
So they're not putting all their resources into projects that might take years to bring in any money, balancing short-term and long-term revenue streams.
Precisely. And lastly, we have the land bank. Developers who snagged land at lower prices in the past have a built-in cost advantage in competitive markets. It's like having a secret weapon.
These diversification strategies are really insightful. It's fascinating to see how developers navigate these complexities, trying to minimize risk in such a dynamic industry. But let's be real, the real estate world isn't exactly known for its simplicity, especially when it comes to regulations.
You can say that again. Navigating the regulatory maze is a major hurdle for developers.
Oh.
Approvals to get, environmental norms to follow, a whole bunch of rules and regulations to deal with. RERA, for example, had been in a big development in India's real estate landscape.
It sounds pretty overwhelming, even for someone who's not directly involved in development. And I know things don't always go smoothly in this world of permits and approvals. We've seen some high-profile cases where things went very wrong, right?
Yeah, unfortunately. There have been cases where developers face serious consequences for violations, mismanagement, that sort of thing. We've even seen prominent developers, like those involved in the Unitech and Amrapali cases, ending up in jail. Those cases involved allegations of financial irregularities, huge project delays, even defrauding homebuyers.
Developers going to jail, that's a pretty stark reminder of how high the stakes are in this industry. It's not a game for those who cut corners or play fast and loose with the rules.
Absolutely. Those cases really shook up the industry, highlighted the importance of transparency and accountability.
For sure. But even beyond the legal risks, securing funding for these projects must be a huge challenge, especially with the economic ups and downs we talked about.
You're hitting a crucial point there. Funding is the lifeblood of real estate development, and it's definitely not always easy to come by.
So how do developers typically secure the financing they need to get these projects off the ground?
There are three main sources of funding: promoter contribution, those customer advances we discussed earlier, and debt financing from banks and other institutions.
I imagine each of those avenues comes with its own risks and challenges. Seems like having a strong promoter, someone who can step up when sales are slow or unexpected costs pop up, is absolutely vital.
Couldn't agree more. That ability to bridge funding gaps is essential. It shows lenders and investors that the developer is committed, has the financial strength to see things through, even when they hit unexpected obstacles.
It's a sign of stability and commitment in a market that often feels anything but stable. So for those of us who aren't real estate moguls but are interested in maybe investing in this market, what are some things we should be looking out for? What are the red flags that might signal a risky investment?
That's a great question, one that every potential investor should be asking. The first piece of advice I'd give is don't be swayed by fancy brochures and marketing hype. You need to dig deeper, do your due diligence.
This industry has a bit of a reputation for being less than transparent, wouldn't you say? So how do we get past that surface level and really understand what's going on behind the scenes?
Transparency is absolutely key. And one of the things you need to be particularly cautious about is what are called contingent liabilities.
Contingent liabilities. That sounds a bit ominous. What exactly are we talking about here?
These are essentially potential obligations that might crop up depending on certain events. They're not always immediately obvious on the balance sheet, but they can pose significant risks down the line.
So they're like hidden risks, lurking beneath the surface that investors might easily miss. Are there any specific metrics or ratios we should be paying attention to when evaluating a real estate company? Something we can add to our investor toolkit?
Absolutely. One helpful approach is to compare the company's current development pipeline to its past projects. Gives you insights into their track record. See if they're taking on more than they can realistically handle.
So we shouldn't just focus on the size and scope of their current projects, but also consider their history and experience.
Exactly. Look for patterns of them overextending themselves or taking on projects that are outside their comfort zone. Another key ratio to analyze is receivables versus construction costs. This can give you a sense of their financial stability, whether they have enough cash coming in from sales to cover their building expenses.
So we're basically checking if they're generating enough revenue to keep the lights on and the construction moving forward.
Precisely. And lastly, calculating potential LRD debt can be really insightful.
LRD debt. Gotta admit, that's a term I'm not familiar with. Could you explain what that is and why it matters?
Sure. LRD stands for lease rental discounting. It's a type of loan where the collateral is the future rental income from a completed project. Can be a valuable source of low-cost financing for developers.
So if a developer has strong potential for LRD debt, that's a good sign.
It can be. It suggests that lenders have faith in the project's ability to generate rental income, which is a positive indicator of its overall viability.
These are some really practical tips. I feel like I have a much better grasp on what to look for when evaluating a real estate investment.
That's what we're here for, to equip you with the knowledge and tools you need to make informed decisions.
You've definitely done that today. This deep dive has been incredibly insightful. The real estate market is clearly a complex beast. High stakes, high rewards, and a whole lot of moving parts.
It's definitely not for the faint of heart.
But now that we have a better understanding of this world, I want to challenge our listeners to really think critically about what they've learned. Would you feel comfortable investing in a project with a developer who relies heavily on customer advances? Or would you look for one with a more diversified funding strategy?
Those are the kinds of questions you should be asking yourselves. There's no one-size-fits-all answer, but the more informed you are, the better equipped you'll be to make smart investment decisions.
Yeah, it really is. And on the regulatory side, we've seen how crucial it is to have a system that protects investors and holds developers accountable. Absolutely. Do you think the current environment strikes the right balance? Or are there areas where we need more oversight to prevent those unfortunate cases of fraud and mismanagement we discussed?
That's a tough one. There's always room for improvement, right? Our ERA has been a positive step towards greater transparency and accountability in India. But how effective it is really depends on consistent enforcement and implementation.
For sure. I've also heard concerns about the sheer number of approvals and permits required for real estate development. Could streamlining that process help reduce opportunities for corruption and delays?
There's definitely a balance to be struck between ensuring necessary oversight and avoiding unnecessary red tape. A more efficient approval process could definitely benefit both developers and investors. But it's crucial to maintain those checks and balances, to prevent cutting corners or compromising on safety and quality.
Absolutely. It seems like the real estate market is always changing. New challenges and opportunities popping up all the time. What are some of the key trends or developments that you think investors should be keeping an eye on in the coming years?
Well, one major trend is the rise of PropTech, or property technology. We're seeing technology being integrated into every aspect of the real estate industry, from virtual property tours and online marketplaces to data analytics and smart building systems. It's completely transforming how properties are bought, sold, managed, and experienced.
It's amazing to see how technology is shaking up this traditionally brick-and-mortar industry.
Yeah.
Are there any specific prop tech innovations that you find particularly interesting or impactful?
Blockchain technology is definitely one to watch. It has the potential to revolutionize property transactions. by creating secure and transparent records, streamlining the transfer of ownership, and reducing the risk of fraud. We're also seeing platforms emerge that allow for fractional ownership of real estate assets, makes it easier for smaller investors to get in the game.
That democratization of access is really exciting. Could open up so many opportunities for people who might not have had the means to invest in real estate before.
Exactly. Another trend worth paying attention to is the growing focus on sustainability and green building practices. As awareness of climate change and environmental impact grows, developers are incorporating energy-efficient designs, renewable energy sources, and eco-friendly materials into their projects.
So it's not just about how properties are built and managed, but also what buyers and renters are looking for. Sustainability is going from a nice-to-have to a must-have.
For sure. And this focus on sustainability is driving all sorts of innovation in building materials, construction techniques, even the way we think about urban planning and development.
It's clear that the real estate market is constantly evolving, and staying informed is essential for anyone looking to invest in this space. This deep dive has given us a great overview of the market's complexities, challenges, and opportunities.
It's been a pleasure sharing these insights. Remember, knowledge is power, especially in a market as dynamic and multifaceted as real estate.
Well said. And to our listeners, we encourage you to keep exploring this fascinating world. Do your research, ask questions, and don't be afraid to challenge the status quo. The more you learn, the better equipped you'll be to navigate the real estate jungle and make informed investment decisions. Thanks for joining us in this deep dive.
I agree. It really is fascinating to see how it's all evolving.
And for investors, I imagine understanding these trends is crucial for making smart decisions.
Absolutely. If you're not paying attention, you'll quickly fall behind.
So we've covered a lot of ground in this deep dive, from the fragmented nature of the market to the importance of diversification, from the regulatory hurdles to the rise of tech. What's the one key takeaway you hope our listeners walk away with?
That's a good question. I think the most important thing to remember is that real estate is a complex and ever-changing industry. There's no magic formula for success, but by doing your due diligence, understanding the risks and opportunities, and staying informed about the latest trends, you can increase your chances of making sound investment decisions.
Well said. And on that note, we'll wrap up this deep dive into the world of real estate. Thanks for joining us. And remember, knowledge is power, so keep learning, keep exploring, and keep investing wisely.